Perfect. Thank you, Leah. Thank you, Mario. Loud and clear. Great. Great. Can you see my screen? Perfect. All right. Let's jump on it, shall we? Great. All right. How to avoid $250,000 in mistakes and fast track your growth. What a great way to start a startup by not spending a lot of money. Let's get into it and just put a little bit of context. We're in the most expensive business environment since 1930, especially due to the tariffs. And so there's a lot of reagents and med tech devices that are going to be increasing that might affect cash flow. And overall, there's also the experts that are going to take an effect on whomever is commercializing already and is already selling. They might have an impact on demand. Nonetheless, we're going to talk about how to make cash part of our system, part of our business, and also how to work with it, with its constraints, in order to have a successful life sciences startup. All right, so let's jump into what it means to be in a life sciences startup. You have regulatory compliance, of course, supply chain shortages, especially now, quality control assurance, scaling from bench to pilot. For those of you that are already completed some clinical trials, this is a new type of effort. Your IP strategy, data management and integration, cross-functional coordination, talent recruitment and retention, securing and managing funding, and then managing that laboratory equipment. Now, this is your core R&D and scientific background, right? This is all related to either science or law or strategizing around the business. On top of this, you need to manage your day-to-day and the financial management of your business, run payroll if you already have a team, review contracts, document everything for compliance, have plans and reports for projects. Grants are now requiring very specific types of reporting, investor and board communications, grant and funding administration, vendor procurement and coordination, and on top of everything else, you're already on tight capacity with limited resources. So let's jump into, these are my sources for some of the numbers I'm going to present today. All of you in life sciences are going to raise between 5 and 8 times. All right, so let that sink in for a second. If your strategy is to either IPO or exit at some point in the next 10 years, you're going to be raising 5 to 8 times. And this comes from a place of the average exit of a life sciences company is between 10 and 15 years. The average round allows the company to live or gain runway for 12 to 24 months. So that's where this number comes from. So you're going to be raising 5 to 8 times throughout your life, unless you get acquired early and everybody's happy and you don't need to spend all that time or all that effort on the fundraising. But this is, for most of you, this is what's going to happen. The average or the median runway today is 12 months. It used to be 16 months for a life science company. So now cash is shorter, right? VCs are not investing as much. They're being a little bit more cautious. They're wanting more reporting, more engagement, more traction. And then 82% of businesses that fail due to poor cash management. This is 4 out of 5 businesses. So the question as to whether there is a market fit or not, or if the solution that we're trying to bring to life sciences is good or not, sometimes gets unanswered because we just ran out of money, or we make some investments early on that might not be needed then, but they sounded great. And so today, I want to point out that this is common. There's one common denominator on these numbers, and that is that they apply to every single player in the field. So everybody in life sciences is going to have to raise between 5 and 8 times. When they raise, they're going to have a median runway of 12 months, and then they're also subject to these 82% statistics. All right. Now, this is a way of reframing things for everybody and saying, well, if cash is important to the point that 82% of the companies that fail due to cash, how can we get better at it, right? Without spending too many resources. There's a lot of fractional CFOs today. There's access to them. I'm telling you, if you're under a specific revenue threshold, you might not need them. And it's coming from somebody who's a fractional CFO, by the way. If you're under a specific threshold, you don't need 20 hours, 10 hours of somebody's time, especially if the rate per hour is slightly higher due to their experience. I'm going to make a point on that in a second. What I want to mention is, what would you do with an extra 12 months of runway? And bear with me just 1 second, please. Trying to get this in place. All right. I need to switch the presentation. Bear with me. I want you to, yes, I will record and provide a transcript. In the meantime, can you, in the chat, tell me what would you do if you could have an extra 12 months, a full year of runway? I'm just going to switch the presentation to have a poll really quick. All right, what would you do if you had an extra year of runway? All right. Delay fundraising, spend less time fundraising, accomplish milestones. Yeah, get there faster. Mario is saying, go heads down into product development. Exactly. That's exactly right. All right. All right. This one really needs, can you let me know if you can see the screen, please? Cool. Thank you. Thank you, Henry. All right. How will you do things differently if you don't need to worry about cash? If you didn't need to worry about cash? This one takes a second. I really need you to think and put yourself in that position. What if cash wasn't a worry? I'm not saying it's not something we're not going to deal with, but a worry. I'm using the word worry in a very deliberate way. How would you do things differently in your company if cash flow wasn't a worry? Feel free to answer in the chat. But ideally, I want to share that I believe one thing, that you should focus on R&D. You could take more risks, iterate faster, pivot, like Mario is saying. You'll have more focus on development, deliverables, do more somewhat simultaneously instead of sequentially, etc. Yes, you would focus on your R&D, you would focus on your science, you would focus on your experiments, and you wouldn't have to be on the side having pretty much a second job, raising money and trying to figure out how to spend the money in a way that it allows you to extend your runway. So that's what I believe, that you should focus all of your energy, all your talent, all your skill, all your innovation or innovative ideas into developing that. And then cash should be something to deal with, but not to worry about. Okay? And by deal with is, that's where I'm going to share in a minute. We're going to have, at the end of this training, we're going to provide access to a cash model so that you can pretty much start modeling cash, modeling your runway, getting some numbers in place. We'll have a Q&A at the end too, and then we'll also give you an offer at the end of this training so that you can evaluate if you'd like to pursue that. All right, so having said that, my promise for you today is that I will show you a framework to manage your cash flow successfully as a life sciences startup. Okay? By the end of this workshop, you will be able to learn the building blocks of how to build a cash flow from bank statements. This is going to be a really interesting experiment for those of you who haven't done it before. Fairly straightforward, but it gives you a lot of clarity really quick. Learn the common pitfalls when modeling cash flow, runway, and spend. I don't like the word burn rate. For some reason, I don't like to think that the money's being burned. I like to think that the money's being spent or invested. I've never used that in front of investors, and I think it's gone well. Learn about $250,000 mistakes that are common, but also 100% avoidable. Be able to start modeling and controlling cash using the free cash model that will be delivered to you at the end of the webinar. Learn the importance of relentless cash monitoring. It says lean. It's learn. Okay? All right. Some of you might be saying, well, I might be too small, I might be too big. How does this apply to me? I have a team, I don't have a team. Doesn't matter if you have $50,000 in the bank or 50 million in funding. If you're at preclinical, phase 1, or already commercializing. If you operate in biotech, pharma, medtech, research, healthcare, or health tech. If you have the latest ERP, it's been recently implemented, or you're running on spreadsheets, and if that, it doesn't matter, you don't have enough time, budget, or resources. That's the very reason why we're having this training today. All right, so a little bit about what I've done. I've had the luck to work in very heavily R&D focused industries with very regular financial cycles, working with SBIRs and STTRs, sometimes contracts that had to follow a very specific time frame tied to milestones, exactly like an SBIR. I've worked with direct to phase 2s, you name it. And in industries that have been highly regulated, life sciences, of course, is one of them. I've worked in aerospace and defense. I've worked in automotive. I've worked in food, specifically beer manufacturing. And it's been an intersection of different areas. And that's where I think I can help you bring the most value. I work with startups that had nothing, no model, no budgets, no infrastructure, and there was no money to buy some fancy system or an ERP to get things going. So we had to be really, really creative and build things using integrations, learn a little bit of code, and then start making things happen for everyone. So that's where I came from. And in doing so, I started noticing that there were things that could be replicated no matter what industry they were. And so I worked at the intersection of cash management, the most important topic for a startup, R&D, these very irregular cycles where you get funded and then everything goes down until you get funded again, so it looks like a saw. And then putting together the financial controls that then allowed me to manage runway and have a very strong grasp of what it means to run a company with tight resources, but also be able to see from very, very far away, similarly to a radar, what is coming your way. And so in this experience, to finalize, I've raised $200 million. On top of that 200 million, I've extended runways for $157 million, and I've done the turnaround of 8 early stage startups. Basically, we rescue them from going bankrupt. All right, so with that, if you guys are ready, let's reframe cash flow. And I want to start with a little bit of art. If there was ever a poem for finance, it's this: revenues are vanity, profits are sanity, but cash is king. And I want to take 1 minute here because you probably have seen very large companies have, financial statements and then these reports, the 10K, the 10Qs, and you see that there's a lot of content. And one thing I can tell you, having worked for a Fortune 500 company and for a startup that had 3 weeks of runway and, rescuing it, is that no matter where you are, how big or small, if the company's producing cash, that's the metric that matters. All the acronyms, all the fancy formulas, they're irrelevant if the company is not focused on cash. Now you can divide cash in short term and long term. You make an investment today hoping that you're going to bear fruit in a year, 2, 3, 5, 10, like you guys. That's totally valuable. But there has to be a cash component. Everything else, I learned, having done this for 2 decades, it's just noise. Now, you can add a little bit of nuance and color to certain decisions, but as long as the company has cash, cash is what keeps the company running. Okay? And just one very quick clarification: revenues is not the same as profits, and profits are not the same as cash flow. I could sell, let's say, $100,000 of a product and not be profitable because it costs me more than $100,000 to produce it. I can sell $100,000 of a product, be profitable because it costs me less, but then not produce any cash because I sell on credit and I collect in 90 days. So I might have revenues, I might have profits, but I might not have cash flow. So I just want to clarify that really quick before we get into it. So are you guys ready? I'm seeing the chat here. The last person to speak was Robert Booker. If you guys are ready, let's dive into building cash flow and finding ways to mitigate losses and become very, very proactive on cash. Okay. All right. All right, Will, I see your K. Start with the building blocks. All right. So we have one building block of cash flow is the operating. It's basically, think of it as the day-to-day, right? Sales, payroll, rent. You can think of it in your day-to-day operations as, paying your mortgage or your rent for your house, buying food, getting gas, all of that good stuff. Next one is investing. It's all the money that you use to invest in equipment, R&D, software. Basically goes to build assets. Think of it, if you're in a day-to-day, think of it as buying a house, something that will, gain value over time, or putting money on the stock market. You're buying an asset. So you're putting money in hoping that it'll return money in the future whether independently by its own, if you're putting money in the market, or by using it to transform goods like equipment would. And then finally, the third building block of cash flow is financing. That's where we do the fundraising, where we ask for debt. And also, it's where we pay, this is the category where we pay dividends, which is a negative type of finance because it's money that's going out. So to place everybody in the right mindset, this is what cash flow is all about. It has three elements. We saw that it could be operating, it could be financing, or it could be investing. That's just a way of dressing up the dollars. But the fact of the matter is that we have cash that comes in, we have cash that comes out, and then we have a balance. That's how simple cash flow is. Now, of course, you want to always have a cash balance. So that means that you need to balance out how much money is coming in versus how much money is going out. Okay? All right. So now let's jump into a very, very simple, this is a it's a bank statement from Chase. It's been redacted. What we're going to do is really zoom in into this section right here. All right. And you can see there's a beginning balance. There's been 10 deposits, adding up to $126,000. Some payments made for $3,000 and $15,000, and then we have the ending balance. So if we were to name this following this structure right here, we'll see something like this. So this is our cash balance at the beginning. This is the money that came in, cash out, and we have a new stock, right? It's basically, and if we were to grab this, and if you want to put it in an Excel file, you could say, all right, I have my first column. Let's get the next month's bank statement, right? You'll start building something like this, right? You enter your beginning balance, how much money came in and out. These are different numbers than from the bank statement. But now you have a way of tying month one with month two, which is the ending balance of month one is the beginning balance of month two. Showing you the mechanics so that you know how this is going to work for you, especially moving forward as you start winning grants or as you start making your first investments, right? And so you can see that here we have an ending balance that's been going down because we've been having just cash going out, right? We haven't had any cash come in. We started with $500,000. Let's say that was from funding or from a big grant that we won, maybe a phase two. And now we're spending that money in different items. But now we can forecast. And this is where it becomes a little more interesting, right? And I think that's the reason why you guys are here. This is where we start playing with the numbers and seeing what the impact of cash is. And I'd say that we wanted this to be positive forever, right? We want the ending balance to be positive. We don't want to run out of money ever, right? And to do that, we need to do a balancing act. And to do a balancing act, we need a little bit of infrastructure. So let's go through the common pitfalls when we're building this infrastructure. In 2023, I was working with an aerospace company. And when I joined this project, the first thing I asked the CEO is like, okay, how much runway is there in the company? And he said, like, oh, we have 18 months, right? If not more, even 20. So I go, great. So how are you, do you have a model, a cash model to check how you're calculating the 18 months? Oh, no. I know how much we're spending every month because I see the reports, and then I see how much money we have in the bank. So basically, I'm doing a formula. All right. And so what he was doing was something like this. I'm using the same example as before. He said, well, on average, very reasonable. I'm spending no big spikes, right? Okay, I'm spending $25,667. My current cash balance is $423,000. So if I were to apply this formula, it'll let me know, all right, I have 16 months and a half, right? This is the way he was doing the calculation. And so if you were to graph this, it'll look like this. It was a linear consumption of cash, right? Because he's assuming that the 25.6 is an average. So one month it might be a little higher, and a different month it might be a little lower. But then when I started asking more questions, because there were some engagements, there were a couple of SBIRs with NASA that required payments to be made to contractors. I started asking, well, where's that money going? And so I started extending the point of view, right? Because there was no planning. It was just at the end of month 3, this is how the runway was calculated. And I pointed out that in month 9, there was going to be a large expense. This was coming from a third party that needed to develop some really heavy hardware. And so now you're going from something that looked like this into something that looks like this, a very disruptive line. Rahul, I just saw your chat. Yes, we will be getting a recording of the webinar. Now, okay. So not looking far into the future, no cash monitoring, and being reactive. So this was missed, right? Why? Because if you're living day to day and you're building rockets, you're not focused on every single aspect of your business, especially if you're growing or you're starting to get into a new project. And so the back of the napkin math said you have 16 months and a half. Well, the number in this example was 18 months. The reality was that the company had 6 months of runway with the current structure. And so it was immediately needed to start a fundraising, okay? So that's the first common pitfall. What was happening was no planning beyond what was manageable for the company as it was growing. And how to solve it? Well, it's very simple. You have a dedicated cash flow model. You project for 12 months so that similarly to a radar, you can see something coming 12 months ahead. And then if you plug it into your model, you'll see what that effect will have on you. And then avoid the runway formula at all costs. I'm going to show you how you can avoid it. I see Mario saying, when do you incorporate key milestones or revenue inflection points into a cash flow model? If you have, for example, it'll depend, but if you have an STTR or an SBIR grant or other types of grants, you usually get a schedule that does not have a fixed date, but it has something like T plus 3 months, T plus 6 months, T plus 9 months. And so that T is an unknown, right? But you could say, well, I've heard from the point of contact that they should have an answer by this date and this should be signed by this date. So you can use that as a proxy. If you want to be conservative, you can push it later into the future and say, well, if this is the starting point, that means that we're going to push everything back. I'm going to show you just how to do that in a second using the template that will be delivered at the end. Another common pitfall is averaging the wrong numbers. I'm going to show you something really simple. We have 3 companies, Company A, Company B, and Company C. We can see that the cash out of Company A appears to be on month 5, Company B appears to be on month 3, and then Company C appears to be in month 2. Now, the interesting fact of this is that all 3 started with $500,000 in cash, and all 3 had an average spend rate of 100K. I'm just showing the tables with the data where the average cash going out is 100K. What's happening here is that we are looking at more discrete spend rates, right? Company A is spending the money evenly. Company B has a 2 very heavy months where they spend most of the money. So month 3 is they run out of money. And company C spends most of the money in the first month. And though this keeps the average at 100K, this is the exact problem that many startups face when they say, oh, I have enough money to cover 500K in the next, because I'm spending at this rate, let's say 100K. If you average your 100K and do not have a discrete view of your numbers, you're gonna, face a brick wall when you realize that the timing has a lot to do with the way you plan for growth. So again, what's happening here? Timing, right? We're not calculating timing. We're not addressing timing. How to solve it? Again, very simple. We have a dedicated cash model. We add discrete dates and numbers. So not just, this is the, how much I'm going to spend, let's divide it by 6. No, we have to go with, this is how much I'm going to spend on this month, and then on this month, and then on this month. And in our case, very specifically, we're going to focus on a weekly basis because cash is the most important thing. Cash is king. Remember, I want you to take at least that poem home. And then finally, you can average fixed costs. Fixed costs being rent, it's not going to change. Fixed costs being maintenance, it's not going to change. And by maintenance, I mean cleaning maintenance. If your electrical bill or your utilities are pretty stable, they don't have a lot of variance, you can definitely average those. But you don't want to average everything that's variable, any new equipment, or when you anticipate salaries to go up because of a new hire or because you're increasing salaries to your team. You do not want to average that. And then we're going to go through a third common pitfall, which is staying too long in the big picture. And I'm going to put it simply. You're staying in the big picture and say, well, this year we have $750,000 of money coming in, and we have $500,000 of money going out. Now, you guys are scientists. I'm sure you know where I'm going with this. Most people would say, well, we're cash flow positive, 250,000, right? 750 in minus 500,000 out, 250. The reality is that your schedule can look like this. You could spend most of your money, have very low reserves, and spend most of the money you had before you get paid that 750, right? Before you collect that 750. Now the schedule 2, that little nightmare right there, is showing you what's very common for an SBIR, which is you have milestone payments with a schedule, and if you don't tie this correctly, you're going to be in a very, very stressful situation. And there's a very simple fix, and I'll explain it in a second. And then the schedule number 3 is it just has one cash out situation very early on, and then it just goes up. However, this type of growth is very hard to sustain, because when you're in your first peak and you think, well, now I can hire people, then you're spending all your money on, let's say, clinical trials, right? And then you get your next batch of funding, and then you can say, well, now I can hire an administrative assistant or an executive assistant. And then no, because now you're going to spend your money on equipment or on recruiting potential patients. And so even though it looks like growth, and it is growth, it is very hard to work through it. Okay. All right. So let's one more time. What's happening? We have low visibility, right? We only have 2 big numbers. We don't have the details. We're staying too long in the big picture. And how to solve it? Have a dedicated cash model. Again, use discrete dates and numbers. Do scenario analysis and negotiate. And this is something that a lot of companies that I work with don't do, which is, well, I cannot negotiate with NASA. Yes, you do. Yes, you can. You should. Because NASA is giving you a budget, or whomever it is, right? It could be a large university grant. It could be a Aetna running a grant for startups. They're separating that money and saying, let's pay it in this schedule. You can go to them and tell them, hey, your schedule is great. I'm not going to move the total, but could we move more money up front? Could we front load a little bit for this? Because I need to make some investments early on and I will be running out of cash. And they will 100% understand it. I've done it, like, I don't know, more times that I can count, with big players, including the DoD, the Department of Defense, NASA, and the Department of Air Force, which you might say, those are tough guys, yes, but we were able to get that by just sharing with them, hey, this is what my cash flow looks like. This is my proposal. Can we make it work? I'm not adding a penny to it. I'm just changing the timing of the payments. 100% of the times I've gotten a new schedule that allowed us to avoid these little, the bumpy ride, even through growth. All right, so now let's go to a demo. I'm going to show you the tool that I'm going to be delivering. Let me know, can you guys see this Excel file? Can you help me, please? Yes, okay, thank you, Rahul. All right, so this is a cash flow model that I'm going to send to you over an email. And it has, remember cash in? Here you go, collections. Remember cash out? Here we go, payments. And then we have financing. If we are getting money, right, it'll be cash in. If we're paying money, we're paying back as a dividend or paying back debt, it'll be cash out. And then we have also these, most 99% of the time, these are cash out because we're purchasing equipment. The only chance where it is cash in is when we sell that equipment, and it'll go into these lines. But basically, if you start from the top, you're going to get the money in, the money out, everything in between, and you're going to get a net cash flow. In this case, it's negative. It's more money going out than money coming in. We can adjust the beginning balance, and then we'll have the math here at the bottom telling us that we're going to run out of money in 3 weeks. That makes sense? All right. Now let's play with this a little. If you see up here, this button, I have turned off sales. If I turn on sales, it's going to add these numbers right here, which are pulling from my accounts receivable schedule. This is something you can pull from QuickBooks, or your bookkeeper can send your way. Paste it here, and now you have incorporated the revenue. And now you don't run out of money in 3 weeks. It's just a scenario for you to say, what would happen if for some reason, I don't know, the government shuts down, right? What will happen then? And so you can run through this scenario and say, well, let's turn sales off. Well, we'll have money for 3 weeks, even less, maybe 2 weeks and a half, right? All right, you say, well, what happens if the government does not shut down, so they can still make payments, but we're not able to collect fully? And I have created 3 scenarios, right? The conservative collects a little less because some people decided not to pay. The probable collects a little more, and then the optimistic one collects 100%, right? You can change these numbers however you want to feel more comfortable and maybe add a bigger spread to the variance. But this will allow you to really quickly have visibility on what your cash is going to look 13 weeks ahead. 13 weeks is a quarter, so 3 months. And you're also going to have a summary here for each of the months where you're going to run the cash flow. The only inputs you'll need is if you have people in your team already, you just write in the payroll date, the payment amount, if you're adding people to the team or not, if you're reducing your team size, and then you'll get the numbers. So in June 24th, this is going to be the payroll number, and you will see it here. Where's June 24th? Here's the 255, right? And we do the same for AR. As I mentioned, this is something we can request our bookkeeper if we are already, we have a schedule for our grants or our clients. And then finally, very same thing for our accounts payable. We ask our accountant, our bookkeeper, hey, I need you to send me the latest schedule. And here you can be very discreet and say, I think I can push these guys from net 30 to net 45. You can negotiate with them so that most of your people is here in this area before you pay them. And then you enter the amount you want to pay, and everything will be reflected here. So 3 ingredients: you need payroll, AR, and AP. And if you have any funding coming in, you can enter it here manually. If you have any CapEx coming in, you can enter it here manually. Everything in gray is for your inputs. You can change it, adjust it to the level of detail that you'd like. But this is something I'm going to be sending your way. And this is something that can allow you to play around and say, hey, we can start leasing out this equipment. I think we can make $5,000 a week if we do that. All right. So let's say that I put it here. I'm just adding 5. This is in thousands. And now we have a new cash flow at the bottom. We know we have visibility for 13 weeks. And if for whatever reason there's a $300,000 hole that we're not seeing today, we're going to have this view where we're looking 3 months ahead, right? Now you want to do this for a longer period, of course, but the cash model is usually a weekly view throughout 13 weeks. You can have this on an annual basis. Okay, I'm going to head back to the presentation. This was a very short demo. There's a README tab on it so that you can go through it with a little bit more time. And let's see. Now let's look at those $250,000 mistakes. We've talked a bit about cash flow. Now I think everybody's a little bit more comfortable. Cash in, cash out, cash balance. Let's look at those $250,000 mistakes. All right. Number 1, 60% of founders regret hiring too early, right? The job is maybe a part-time, or maybe it's just a very spot work that needs to be done for a month. You can hire a consultant. You can hire somebody part-time for a couple of months. Just don't get overboard when you get funded and you say, like, now we have money, now I'm going to relax. Because the fact of the matter is, if you hire too early, it's going to cost you. So I'm going to create this little receipt here where I'm going to be adding everything. So hiring too early, it's expected that it can increase your costs by $50,000 to $100,000. I'm grabbing the lower bound here. Now, 70% of startups scale prematurely. They go buy equipment. They go get a lease. They go hire a lot of people like the item before. And what that does is, well, first of all, you have alternatives, right? You can rent a lab. You can just send your tests to a laboratory and they run them for you. They give the results, and then you can move forward from there. You don't need the extra space. And one big secret I can tell you is investors don't like if you have an office that does not produce any revenue, right? Unless it's an sales office. They would rather meet you at a Starbucks and you telling them, hey, I'm not renting because I want to keep my fixed costs low. If you want music to investors' ears, people that remain lean are the ones that they want to stick with. All right. So this adds another $50,000 of it's CapEx or getting into a lease, okay? The lower bound is 50, the upper bound is 75,000. 65% of startups spend 14 hours per week chasing invoices. This is basically we already have revenue from a grant, or we have money coming in from a grant, and we're going to spend almost 2 full days getting ahead of, or sorry, getting involved and in touch with this person that it's our point of contact that rarely responds. And we're just sending them the email about, hey, where's our payment on the day of when it's due. That person has no idea. They're doing 100 different things, and they're just going to start the process of that. If you had a tracking system, you could start sending them or sending yourself messages that says, hey, in a week, you should start triggering that invoice. So in a week, you should start calling these guys, or maybe right now, so that you can get paid on time. In the US, 55% of all invoices are paid late. All right, so this adds an extra $25,000. This is basically not being able to have that money. So you lose 2 days of one person's work. And also you might get into financing costs. You might make some payments with your credit card while you're receiving that money. That takes an interest. And over the course of a year, that's between $25,000 and $35,000. Again, I'm grabbing the lower bound here. All right, this is a good one. 70% of R&D heavy companies do not claim their R&D credits. That is billions of dollars that are left on the table. All right, it doesn't matter if you're a startup or a big. So only 3 out of 10 companies that are doing R&D work are actually getting into the, filling up the forms and sending them to get some credits. The effect of this, I'm using the upper bound goes, into the millions. I'm using a very conservative 25,000 for a startup, for an early stage startup. All right, 80% of clinical trials have delays. That is because the recruitment is really hard to begin with. And then there's also people that are already recruited that drop out of the trials or the assessments. This is a statistic from the National Library of Medicine. So 8 out of 10 clinical trials are delayed, which means, by the way, they're delayed by a month to 6 months, which means you need to keep everything running for 1 to 6 months. Okay, you need to keep your if you have any staff, keep that rolling. If you have any licenses, software, contract work, you have to keep paying for stuff to keep things going. Especially because they get delayed, now you have to go back, recruit new patients, and you pretty much need the same team. You might be able to be a bit more efficient, but you're just spending some time and money on that. So the delays creates an OPEX increase, operating expenses. Of the lower bound is 75K, the upper bound can go into the millions. And this was misplaced. Okay, 67% need late stage remediation. This is basically a lot of biotech companies that go to the FDA, and the FDA runs their audit and they see that data integrity is not there. And so GDPR, and they have to go back and remediate, and that increases legal fees and resubmission fees. So that's 67%. So if we add everything together, that's $250,000 on the baseline, right? That's the starting point. All right, that's the lower bound. This can go into the millions. This is the typical case for a startup that has between 100K, and $1 million. This can definitely grow and compound with a higher revenue numbers. All right, so cash monitoring today, I wanted you to see it, as I said, as a radar, right? You're able to see things a month, 2 months, 3 months in advance. And then with one single screening, you identify your flags, right? You need to do weekly reviews, right? This cannot be just, you have the Excel file, you can use it, you can just get in there, get into the discipline, and run weekly reviews. Now, you have to keep this updated. So you have a forecast of what's going to be like. And if you don't update it, it's not going to be useful, right? It has to be constantly updated with new numbers as you transform those budgeted numbers into actuals. And then finally, you have to communicate the data, right? Hey, can we delay this? Can we negotiate this? Let's chat. That data needs to be communicated. So let's do a quick recap of what we're done. I think we're over time right now. So the quick recap. We have learned cash flow building blocks and build one with bank statements. We have walked through common pitfalls when building a cash flow model. We have identified the mistakes to avoid and to keep $250,000 in your pockets. We have also walked through the cash model to see it work live. And we have learned the importance of constant cash monitoring. I have a question for you. Was your time in this webinar worthwhile? Yes, Sabrina, I hear that. Will, thank you. All right. Did you learn something you didn't know before? Thank you, Robert. I love that hard room, Juan. That was great. Michael's, of course. Mario, I'll send that after the webinar. All right, so I'm happy that you're getting new information that's going to help you run your business. Can you see yourself doing things differently? And I'm hoping it is based on what I'm hearing or seeing here on the chat. All right, so here's what I said I was going to offer at the beginning. Oh, thank you, Robert. That's very kind. This is the offer that I'm going to make. And there is a big component to the offer, and then there's some details that I'm going to share with you. This is exclusive to the people in the webinar. The offer is, we can run a full cash assessment to tell you where you're standing and take that to build a weekly cash report that's going to be sent to you every week, every Friday. And then you're going to have 1 hour with me, a quarterly basis, to update your financials and look again 3 months, 6 months, 9 months, and 12 months ahead. We're just going to be covering the budgeted numbers and comparing them to actuals and saying, hey, this has shifted, and we're going to just update everything. All right. Now, you might be thinking, well, I'm going to charge like a fractional CFO, right? Roughly 20% of the fees of a fractional CFO. I'm assuming lower tier, like somebody in just dedicating just a few hours a month. That's the number that most people are expecting. It's not, because we are working with startups. The price is $600 a month. Now, this includes the assessment, the quarterly review, and then the weekly cash reports. But we have a partnership with Aquilius Ventures. So for the webinar attendees, we're charging $497 a month. And if you're interested in having this system, there is a 24-hour trigger for an extra $200 discount that's going to do the cost of $297 a month for this cash monitoring system. You just need to use the cash 200 on the checkout, and we're only offering 10 spots for this. Okay. So again, you get a full assessment, weekly cash reports, and a quarterly cash review for $300 a month. If you multiply that by 12, that's less than half of 1 month of a fractional CFO for 12 months of continuous monitoring. If you want to check the offer, here it is. I'm going to send it also in the email at the end of this webinar. But I want to show the exclusive bonus, and this is where I think we're going to really stand out. We are going to provide a live dashboard. So your information is live, right? This is 100% free. It's valued at $1,500. The dashboard, we already built it. We just need to plug in your numbers, connect you through QuickBooks, Xero, whatever system you're using. Even we can do Google Sheets. And now you have a live dashboard that has an alert system in it. So every time something happens, you get alerted. And we can define what those alerts are. The other part is we provide emergency support. If you have a 90-day alert that your cash flow has reached 90 days or less, we will reach out to you within 24 hours and schedule a call to plan how to get you outside of that danger zone, right? So it's kind of like having a doctor that's on call whenever you're in a situation of a cash crunch, okay? Now, we've also developed this beauty, which is a 24/7 Q&A cash Centurion that uses AI. So it basically talks to your financial model, it talks to your cash flow model, and you can ask it anything. Hey, what's my runway today? Boom. What's my cash position? Here it is. How much was my spend last month? Here it is. And we integrate it through Slack. Slack is free if you want to use that option, or if you already have it. We integrate it to Slack, so you can ask it any question at any time. This is included in the package. And then you'll have access to all the webinar tools. As you guys know, we're making 12 different webinars. This is the first one. So you'll have access to all the tools, all the webinars. You're going to have access to partner discounts if you choose to. We work with Carta, Brex, Ramp, and NetSuite. And you have this referral rewards program, which has unlimited value. Basically, if you refer a client and they stay for 3 months, you get 1 month free. And then if you're feeling a little like, I want to test it out, there's a 30-day money-back guarantee. If we do the implementation and you don't see the value of it, we give you your money back. And so to put it all together, you're going to get a full cash assessment, weekly cash reports, quarterly cash forecast session, plus all the bonuses, the live cash dashboard with the alert system, the emergency support whenever your cash falls under 90 days, 24/7 Q&A using AI, access to all webinar tools, access to partner discounts, referral rewards program. And if you want to get the offer, here it is. It's $297 dollars per month. Today only, there's only 10 spots available. And if you want to log into it, here it is. And I invite you now to Q&A. I don't know